Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode of Educational Alpha, Bill speaks with Chris Addy, CEO of Castle Hall Diligence. They enter the multifaceted world of operational due diligence, exploring its evolution, current challenges, and the profound impact of technological advancements. The conversation also touches upon various industry shifts, including the role of regulation, transparency issues, and the dynamic nature of asset management. Listen in.
Chris Addy, welcome to Educational Alpha.
Thank you very much, Bill. It's a pleasure to be here.
I think we loosely hatched this plan in Montreal late last year. Been looking forward to this. You're a very provocative but thoughtful commentator, in social media and elsewhere, so it leaves little room for doubt as to where you stand. And having definitive views, I think, isn't always a good way for a professional or anybody to conduct themselves. So there's a lot for us to talk about. But before we get into that, I know your journey currently has taken you as founder and CEO of Castle Hall, but maybe a little bit on your background first, and then we'll move forward.
So I am the CEO of Castle Hall Diligence, where I lead a team of almost 100 professionals conducting operational due diligence on behalf of a group of investors worldwide. And we currently cover full scope due diligence on more than 500 asset managers per year. From a data and ongoing monitoring perspective, nearly 2,000 managers. So we have a fairly broad sense and sentiment of where the industry is, both in public market hedge fund alternative investing, as well as in private markets, be that private equity, VC, private credit, infra, real estate, etc. In terms of personal background, I am for my sin a chartered accountant. As you can tell from the accent, originally from UK, I trained with Deloitte in the UK before having a hardship posting to Bermuda in the early 1990s, where I first of all got involved in offshore finance when hedge funds were very much the secret club of the super rich. So really see them in the Caribbean or in Geneva. And I started operational due diligence working for a large offshore philanthropy, essentially a single family office where the founder elected to disperse his wealth philanthropically. I had the great pleasure and privilege to work with the Atlantic Philanthropies, which was founded by Charles Chuck Feeney of the DFS Duty Free Shoppers Group. I was hired as Atlantic's accountants. I had more than 100 asset managers on my roster, and I realized I would get fired if the numbers were wrong. So it seemed to me to be a very logical thing to go and visit some of our key relationships and say, hey, how do you reconcile to my custody account and ensure the valuation are correct? And at that time, I started in 1997, they all rather looked at me and said, well, these are fair questions, but you're the first person ever to come to ask them. So I've had the chance to visit asset managers for now, actually alarmingly coming up to a good, more than 25 years now. I'm also a CFA charter holder, so I have a dangerous combination of accounting and a little bit of investment knowledge. And I have passed level 1 of the KIA.
Excellent. Well, a couple of observations and we can move forward. We all need to have mentors in life. I saw a very nice tribute that you wrote to Chuck in his recent departure after many, many years on this good earth. So may he rest in peace. And I am also a CPA from background, and I had an even harder hardship posting on the east side of Manhattan with Price Waterhouse many years ago. And I passed both parts of KIA, and I'm a level 2 CFA candidate. So Chris, when you come back to level 2 of KIA, maybe I'll go back to level 2 of CFA and we study buddies. But I think it does underscore the importance of professionalism, because we are in a very complex industry. It is not a profession, but I think more of us that really believe in professionalism, it's going to lead to better outcomes for the end clients. So congratulations on all of that. So moving toward Castle Hall, I've been in and around this industry for over 40 years, and it's been interesting to see some of the developments. And you can take the other side of this clearly, but when I first heard about operational due diligence, I was part of the Robeco group, and they had bought a fund of funds. And it seemed like back then, operational due diligence was a bit of the hood ornament, that it was kind of happened at the end, and it was really of a check the box exercise. And I don't know if an operational due diligence professional could kill a deal. That's not talking about Robeco. I think industry as a whole, I think that was a general observation that I had. And here we are today, and we've seen how operational misfires could crater an investment. And it really has become an important part of the underwriting. And I think the role that you and Castle Hall play, I think has gone through a bit of an evolution. And maybe now we're in revolution. And in a moment, I want to talk about some of the fintech developments, but maybe talk about what you've seen. I think Castle Hall started circa 04, 06 timeframe.
Castle Hall started in 2006. I left Bermuda to move to Canada, as you would, around that time period. I think the history of due diligence is quite interesting. I think, first of all, to your point with respect to professional credentials, I'm not necessarily sure it's exactly what letters you have after your name, but that sense of professional skepticism, equally holding yourself to a consistent standard of professional outcomes, notwithstanding the potential conflicts and pressures of getting in on a very lucrative deal. I do always say, to a slightly different perspective, that ultimately in due diligence land, we are paid to worry about what can go wrong. And yes, I'm sure we will. As some people forecast 9 out of the next 3 recessions, we will probably forecast 9 out of the next 3 blowups. I think that fundamental professional skepticism and really holding ourselves to a well-structured and thoughtful program of professional activity related to the assessment and analysis of what can be both very exciting investment opportunities with great return potentials, but equally organizations that are very sophisticated in their strategies and their structure. I think that's an important part of the process. And history-wise, due diligence started in hedge fund land, sort of an optional extra. For those with a long memory, there was a fund called Manhattan, which blew up in 1999, and that actually was in Bermuda. The administrator was actually next door to Pricewaterhouse's office in Bermuda. And then in 2002, we had Lipper, Lancer, KL. In 2006, of course, we had Bayou. I did once visit Bayou's office subsequently with the new tenants, and the bullet holes were still in the wall. That was one for the anecdotal books. And then, of course, we had Madoff, along equally with Petters, Weavering, and the number of other frauds. So I think a difference in that period, due diligence was very much about a report at a point in time, typically when we were underwriting an investment. It was very much an art, not a science. There was really very much a sense of industry standard or standardization across different practitioners. The firms themselves were completely different. I think what happened in the GFC, the financial crisis, and equally in the aftermath of Madoff, first of all, clearly, due diligence in hedge funds became mandatory, not optional, given the tremendous financial impact and impact on trust in public market alternatives that resulted from the Madoff blow up. And I think equally, we had some pretty significant changes in business and operating model. The comments that I still hear now from private equity firms about how they don't want an administrator because they've done everything in-house and their people are better than anyone an administrator could hire. It's a broken record from exactly what quite a lot of the self-admin hedge funds were saying back in the early 2000s. So we have moved in hedge fund land, I think, to a pretty well organized and relatively consistent operating model, reliant both on, first of all, a pool of very capable individuals working within organizations at every level of the back office, be that middle office, front back office, compliance, information technology, etc. We have great technology tools available to support the full gamut of sophisticated hedge fund strategies and sometimes quite enormous volumes of transactional processing if we're high frequency trading or complex option type strategies. And of course, we have great service providers, particularly with the growing capability of the administrators. So it's a little bit of a chicken and an egg, I guess. You could say clearly after Madoff, there was a need to change, but in many ways, the changes that came through, I think operational due diligence and the practitioners, those of us who were active in the industry before 2008, it was a little bit as if we really took our top 10 list. And I think generally we're able to implement the majority. Now, there certainly have been a continued range of hedge fund frauds and failures in the subsequent period. But I think at this point, to accept something, I think really Madoff has two implications. First of all, to find something acceptable, particularly for an institutional fiduciary investor, of something that had such a weird operational and business infrastructure or lack thereof, and it's basically just trust me, I think that has gone away. And then I think secondly, one of the first rules of due diligence is, I always like to say, is if somebody doesn't want to tell me something, there's probably a good reason why. And I think in the hedge fund space, for an asset manager to decline a plausible due diligence discussion that is well organized and is calibrated and is not unduly intrusive or disproportionate in terms of time commitment and resources, that I think would be essentially impossible in the hedge fund space in 2024. Now, that doesn't necessarily apply to private markets, particularly in areas such as venture capital. So I think one of the most fascinating things here about due diligence is hedge funds are almost a little bit now more standardized and structured. Plenty of issues and nice to haves and enhancements that may, from my operational side, would probably like to have. But there is, I think, now quite a bit of a gap between where hedge funds are and where certain elements and certain sub-strategies, areas of the private market space are.
You cited quite a few cases there, Chris, and I think we cover some of this in the Kaya curriculum. And if I look at Madoff, that's probably signifying a system-wide failure to maybe recognize with 2020 hindsight what now seems so obvious. And Madoff made himself part of the system, and people gave him a break. But we're going to see this movie over and over again. And I don't know if it's Madoff 2.0, but if I look at SBF and FTX, here it is in cargo shorts and a T-shirt. And there were a lot of failures to really not only recognize some of the base level governance issues, but I think this was a classic case where I thought you did the due diligence. No, I thought you did. And I think everybody was relying on somebody else. And I know it's much more complicated than that, but are there some parallels you can draw to those two? And was it just the passage of time, or are we just failing to absorb the lessons we learned from Madoff? And do we expect to see an SBF 2.0 at some point?
It's a fascinating situation, and it's easy for me to say if it looks too good to be true, it probably is. I could also say that FOMO, fear of missing out, is not an investment strategy. I think it is important to recognize that we were in a period we've had, it's not really the cheap money decade, it's the cheap money decade and a half of zero interest rate policy. I heard it described in one place as the Goldilocks investment environment. So we were in a period where a lot of things were going up and high returns were being generated. Innovations were coming along, of which, of course, digital assets, cryptocurrency was a key example. It is always, by the way, really mindful. I'm showing my age. And for anybody who's, I know this is a podcast, but if we have the video, you'll see my lack of hair. I did have some hair at some point earlier on in my career. But as many people are in our industry, it's now 16 years since 2008. We're in 2024. A lot of people have gone a long way in their careers since that financial crisis and haven't known anything apart from the Goldilocks era. So segueing over to FTX, clearly crypto has had multiple problems, teething problems, Mt. Gox, Quadriga, the gentleman Gerald Cotton in Canada, who died aged 29 and was immediately buried with a handwritten death certificate that may or may not have been proof of his demise, shall we say. So just a lot of Netflix-ready adventure Indiana Jones in the financial markets on the crypto side. And we certainly were very hesitant with respect to digital assets from the operational due diligence. And it was not necessarily a case that crypto funds were failing inherently because of crypto. It more often was because of more basic problems around just the organization of the asset management business. An asset management firm, it's just a company that makes something. Except out of our factory, we don't drive out of the factory door, factory gate with a truck full of widgets. We generate investment performance. So do we have a business that has an operational infrastructure that's adequate and suitable for its purposes? And in crypto land, even the basics such as segregation of duties, such as any sense of compliance, controls around personal trading, all these sorts of things were oftentimes blatantly and quite astonishingly absent. Which does also raise the question of, first of all, were people doing operational due diligence? And even if they were, was anybody listening? Because clearly people were investing notwithstanding. And then when we segue over to an FTX is first of all, it's not a fund, it's a portfolio company. So the question is, were the private equity and venture capital firms that included really the A list of A-class investors, investment management companies in the VC space, what degree of due diligence were they doing on this portfolio company? And I do think this raises, with the benefit of hindsight, at least an opportunity to reflect to, first of all, what should be in venture capital the VC general partner's responsibilities to conduct a baseline of due diligence on those portfolio companies that are introduced. And secondly, what should be investors' expectations on those VC managers to actually push them to do potentially a little bit more. It's really interesting in FTX, the amount of comments that it was venture capital firms. I'll say Sequoia is probably the most high-profile one. And the comment was, well, Sequoia is going to lose. No, Sequoia is not going to lose. Sequoia's investors in Sequoia's funds, and that money is ultimately owned by tens of thousands, if not hundreds of thousands of pensioners through many, many different pension schemes. That's whose money it was that eventually was destroyed. FTX operationally was an egregious and astoundingly incompetently managed organization from any baseline degree of accounting and operational analysis. It wasn't audited, or at least it wasn't audited until the very end. We had no-name auditors in the first place. We had a COO who was in her 20s and had only got a couple of years of prior experience. The general counsel had previously got caught in a poker fraud lawsuit and criminal complaint. These weren't red flags. This was a battalion of red as far as the eye could see. But I think clearly we got caught in the cult of the founder. And I'm a risk-averse accountant who, as I say, is paid to worry about what goes wrong. But I am reminded of the story when Bankman-Fried or Bankrupt Fraud was pitching to Sequoia. He was making his pitch, and then his colleague came over to him. He was in an open plan office. His colleague came over to him as soon as he was finished and say, "Hey, that sounded good. How did it go?" At which point he realized that Bankman-Fried had been playing League of Legends at the same time. And the thing that's interesting is that it certainly appears that the investment professionals evaluating this investment opportunity didn't see that as a sign of arrogance/incompetence, actually saw it as a sign of quasi-genius. Now, I personally can't play video games when I'm trying to do some due diligence, but I don't know. I must be too traditional. But I think this cult and hubris, it's not your money. Whose money is it? Who do you have a responsibility to behave with fiduciary prudence, while at the same time, obviously, deploying your skill to identify those great investment opportunities? And I just want to actually make that point. It isn't the job of operational due diligence to say no. Nothing's perfect in this life. We are here to help deliver better investment outcomes. We're at the table wanting to drive better long-term performance. And I believe that important elements of that are, first of all, hopefully avoiding the once-in-a-decade fraud and blow-up, but equally ceteris paribus, it stands to reason a investment management organization with better controls, procedures, fundamentally a better way of producing its product will over time produce a better product solution, which in our case, again, is investment returns.
So you said it quite well a couple of times in there, Chris, in terms of responsibility of the industry and using Sequoia as an example. When it comes to AUM, assets under management, that gets you on the league table. It gives you balance sheet to invest and reinvest, create new products, et cetera, et cetera. But I think we often forget it's the client's assets under our care. And I think constantly reminding ourselves who owns these assets. If we can accomplish nothing else, I think that in and of itself will lead to better outcomes. But I think oftentimes the ownership of those assets is accrued much more toward the manager GP when they're owned by an investor ultimately. Every single AUM dollar is owned by an end investor. So I think that's something we've got to make sure we get into our thought process.
And I would actually just reflect a little bit. I think we underestimate or don't really focus on the degree to which the industry has changed. Again, I have the privilege and just good luck to be in the right place at the right time and see hedge funds. I first saw my first hedge fund in 1994. I arrived at Pricewaterhouse in Bermuda. The Bank of Bermuda was the world's biggest fund administrator. The 10 Commandments were still in place. The Citco, the Curaçao International Trust Company, was a few folk in the Antilles sending telexes. It was a completely different world. And the money came from private individuals, Chuck Feeney being an example, through a billionaire through a private family office. If you are investing for private individuals, for the infamous Swiss billionaire, then what happens to that is nobody's business but their own. But I think what we underestimate is the degree to which we all focus on the fact that alternatives have grown so substantially. I think it's $26 trillion that the SEC quote in their private funds legislation. That has grown exponentially, at least by a factor of 10 over the past 20, 25 years. The vast majority of that new money coming in is from institutional investors, which mean sovereign wealth funds and or pension entities. So if, for example, despite the English accent, I live in Quebec, in Montreal, so La Caisse de dépôt et placement du Québec, I can't opt out of that. That has assets of 8 million Québécois. The Canada Pension Plan Investment Board handles the pension assets of our Social Security retirement safety net, which is now 40 million Canadians. So it's everyone's money that is being put into the system. And I think we do have to remember what it is, whose money it is, and equally the purpose behind which those investments are being made, which ultimately is to improve funding and long-term sustainability of both defined benefit and defined contribution pension plans as they may be structured. Just as an aside, one obvious point there, a lot of talk in the private fund rule about quarterly reports, valuation, a lot of comment in the industry with respect to the valuation of private assets, especially real estate, but equally private equity. And a lot of comments are, well, it doesn't really matter. These are 10-year investments. We can't get out. We're a patient investor. We're a long-term investor. Well, we certainly have to provide an actuarial funding ratio every year, if not on an intra-year basis. That funding ratio is absolutely critical. So if we can't value the assets correctly, we have to remember what the assets are being held for, what their purpose is, the structure that the assets are coming in. And it's a very, very different world from dealing with Swiss billionaires.
And that might be an interesting segue to regulation. I think you opened that door right there. Maybe if I use an everyday analogy, if I hire somebody to cut my grass, they should be able to tell me what I'm going to be charged and how I'm going to pay them. And if I want to get best pricing or what are you charging my neighbor, there should be some level of transparency there. So I think we've got an industry that perhaps does not necessarily believe in full transparency, and maybe there are reasons for that. And then tell me what my value is at the end of the quarter. And can you audit it? These seem to be base level principles. And then there's been a lot of debate about the role of fiduciary duty and what kind of liability comes with that. And this has all been subject to great challenge. And there's an active lawsuit by some of the industry lobbyists on this very topic. And regulation is not perfect, but it gets back to maybe our earlier discussion on whose assets these are in the first place. And ILP has been very active in the comment period. They did an amicus brief that Kaya signed off on, which is saying, hey, this regulation is not perfect, but there are some aspects of this that the LP wants and needs. So why are we ignoring what they want as the asset owner? And I think it's easy to perhaps unionize the views of the LPs when it comes to an amicus brief or a case like this or comment letters. But then when it comes to the rubber hitting the road about allocations individually, it seems like the GP is holding a disproportionate share of the cards because manager selection and manager access matters so much. And if you cry foul, you get to get into Fund X+1. So it's very complicated. Regulation can maybe level the playing field, but maybe we can start with the private advisor rules that the SEC's proposed, but maybe talk about the transparency between LP and GP and what is the state of affairs there.
Rarely is there a simple answer to a complex question, and rarely is a rule or a framework perfect. But certainly from Castle Hall's perspective, we strongly support the principles that the SEC has outlined as a basis for action. And by and large, we support the specific rules that have been promulgated. One comment that I would have here, there's about 20,000 registered investment advisors, about 15,000 dedicated in the US, and then there's quite a lot of ERAs, exempt reporting advisors as well. Since 2012, when regulation became mandatory for everybody apart from VC and real estate, if I had to pull a number, I would say that let's say the SEC's had chance to do an inspection on a quarter of them, so 5,000 for argument's sake. That's a lot of work, and the SEC are not stupid. They know where the skeletons are buried. They've read prospectuses, they've looked at the detail of accounting of fees and expenses, they've introduced numerous enforcement actions related to deliberate as well as accidental problems vis-a-vis fee payments and expense items. Of course, the whole private equity due diligence initiative really started in 2015 when the SEC was able to find that pretty much most of the major players in private equity land had all been engaged in the practice of accelerated monitoring fees, for example. So they know where the problems are and are informed. This is not just an ideological, un-American view of trying to unduly criticize rich investment managers. The SEC say that there are three problems in private funds. And by private funds here, we mean anything that is not a registered mutual fund. So this is hedge funds through private equity, venture, real estate, infra, private credit. They say, first of all, is a lack of transparency. Secondly, there are conflicts of interest. And thirdly, there is a lack of governance. It's very interesting to see the SEC's views on LPACs, for example, which are almost deemed to be as much of the problem as they are as a potential solution. Those three things, lack of transparency, conflicts, lack of governance, we would certainly agree with those from a due diligence perspective. And I think I actually wrote in one of our Castle Hall's blogs that the first draft of the rule is almost as if the SEC had gone around the industry, got a few hundred due diligence reports written by Castle Hall and our peers. We talk to each other. We're all saying exactly the same thing. We've seen the same problems. I think it's the points that ultimately have come out here, which is transparency over performance, transparency around fees, various prohibited items, notably through charging of certain costs and expenses, and then a prohibition on preferred treatment, which really sort of the main thing people are focusing on more than anything is side letter transparency. These are all very interesting and varied points. To take the first two there, valuation and fees. So valuation, it really is an interesting point where we have to say, well, what is the performance? Can we measure the performance on a quarterly basis? Very notable that the SEC wants to have performance which is presented both with and without the impact of subscription credit lines, which is just really embedded leverage paid 80% by the asset owner, by the LP. That will enforce a quarterly process of valuation, and it will also mean that asset managers, GPs, are going to have to take valuation much more seriously. They can't sort of slough it off of, hey, just sort of quarterly BRE estimate, finger in the air stuff. This is going to be a formal statement, which is delivered under the marketing rule, delivered as a fiduciary to the asset owners. On the fee side, the SEC is asking for fees at three levels. The fees the asset manager GP receives from the fund, all of the fees in total that are paid by the fund to anyone and everyone, being all the other service providers, and then also the fees that are paid to the advisor by underlying portfolio companies. And that, of course, really only applies in private markets, not in hedge funds. Two comments quickly there. First of all, I'm an accountant, not an attorney. But the degree of complexity in fee disclosures has become quite extraordinary. It's not unusual now to see 2 or 3 pages in a dense offering document, prospectus, or related LPA of all of the expenses that can be charged to a fund. Sometimes you're reading it and go, I couldn't even have imagined that these expenses could exist. I saw one recently which had costs of public relations agencies and speech writers. So if something bad happens with a portfolio company and there's an ESG problem or something, and the manager is being criticized for making bad investments, well, they can charge the cost of their public relations troubleshooting team back to the investors of the fund, which I thought was quite interesting. There's so many things listed. The questions really are twofold. So first of all, can you see at least a total? And you can see that in the fund, but you can't see it at the portfolio company level. A lot of fees are buried at that level and or have been wrapped up into deal costs, so essentially are capitalized in the cost of acquisition. And then, so can we even see a total? And once we've got a total, can we actually start to put that on a granular basis as to exactly what is being spent of investors' capital? The first thing I would do if I was on a board of trustees or a board of governors of a pension fund is I would require that my team prepare an analysis of all fees across all the investments that we own. So let's say we have investments with 100 GPs that have 400 different funds, for example. I would want all of that amalgamated. So to be able to say, well, how much are we spending on legal advice? How much are we spending on recharge compensation? How much are we spending on travel and things of that nature? So I think there will be a real, I would say, moment of reckoning. That's a little bit unduly tabloid. I think investors will be really shocked. It's one thing being given a very, very long list of dense legalese. It's another thing seeing a number. And there's a reason why, obviously, there is such pushback as to having basic transparency and comparability as to what fees are being expensed. Obviously, every dollar that is spent on a fee and paid to someone in the private fund ecosystem is a dollar of investment return that is lost and is a dollar that can't compound over time. And for long-term patient investors, those dollars really mount up.
This is season 2 of this podcast, Chris. I had Josh Lerner on just a couple of weeks ago. I'm not sure if we covered this, but he's been very public about the evolution of this space. And private equity and private markets by no means mature, but it's gone through a very rapid maturation process. And my words, not Josh's, but if I liken it to a young kid that puts up a lemonade stand on the street, OSHA and the FDA, and they're not going to show up and regulate what that child is doing, selling little cups of lemonade. But when it gets packaged and brought into a big box store, this is big business. And I think to say that the private equity space is the domain of the Abu Dhabi Investment Authority and Yale's management company, it is, but it's so much more than that. And if I've got median returns, and we see this in the private markets that are largely undifferentiated from the public market proxies and performance dispersion, you could drive a truck through. There's got to be greater transparency around what is driving that performance, manager selection, valuation, really understanding what IRR is. And I think that's a big question mark. And then this is all happening around democratization. And the average person on the street doesn't have unfettered access. But we're seeing the SEC tinkering with definitions of accredited investors. And more the average investor does not look like and have the network effect of Yale. So I think it's maybe a slight disingenuous statement to say, leave us alone. These are big institutions negotiating with big institutions. They know what they're doing. It's grown so far beyond that. So I think if nothing else, I think we have to recognize that growth has its consequences. It has its responsibilities and probably has its needs for regulation.
2 points that come from that. I think, first of all, as we mentioned a few minutes ago, this industry has fundamentally changed in that now a strong majority of capital, the growth has come from pension funds, and from ultimately a pension fund is an aggregator that pulls together the assets of tens of thousands, hundreds of thousands of underlying normal individuals, so to speak. It's a little bit disingenuous to say, on the one hand, that private equity and other areas of our industry delighted to have extremely rapid asset growth with related increases in revenue. As everyone points out, management fees on a $10 billion fund are the same as on a $1 billion fund, and it doesn't cost 10 times as much to run a $10 billion fund as it does a $1 billion fund, obviously. We've been very happy to accept this mammoth influx of capital that has fundamentally changed the makeup and shape of the capital that is deployed into this sector of the asset mix. Yet we still want to treat everyone as if they were private Swiss billionaires. So it really is, again, as to your analogy, it's sort of saying, probably it's the other way around from a lemonade stand. It's as if we were previously offering a highly exclusive club that only a handful of people could get in. And now there are ultimately millions of people in the club, so to speak, so that the breadth and reach of the industry has very profoundly changed. When you look at the economics of this, I certainly am not as sympathetic to the cost that compliance becomes ever more expensive. It does become more expensive. We are not, and investors, we recognize the costs involved here, but equally, you're running a complex business and it is an industry that is relatively well compensated. One of my best friends runs a daycare. I sometimes tell him about what goes on in our industry, and he's utter disbelief. Running a daycare is not a particularly lucrative thing, and yet the regulation that Mr. and Mrs. Smith in the street have to deal with in their normal businesses can be very, very substantial. There's a real disconnect there between those two sides.
You better return that asset at the end of the day in better condition when you took it in, and maybe that's an apt analogy.
Exactly. So I think this is an industry that has really changed in terms of its structure. I think as we look forward, what is going to be the appropriate structure that really reflects that change in the asset mix?
One last thing, and then I want to finish up with fintech and what that means to your business model. When we were last together, we just had a brief conversation before. This is an SBAI meeting up in Montreal, talking about how we can make the world better. And you made a quick observation about a master ISDA agreement. And if I'm entering a derivatives contract under a master ISDA, there are standards and rules and regulations and transparency. And I think bemusing the fact, could there ever be an equivalent in the private markets? So I didn't have a chance to flesh that conversation out with you, but curious to see. I thought it's an interesting observation, and it's obviously stuck with me. So maybe a couple of views there.
I mean, again, I'm an accountant, so I'm allowed to criticize attorneys, probably. At ILPA, their private fund survey that was actually submitted as a comment to the SEC is one of the most damning documents that I've read, just really providing transparency around the quite egregious self-dealing of the process of preparing a fund. You have a group of attorneys that produce a document. They're then able to stimulate multiple rounds of renegotiation. You could have 50 investors all asking for exactly the same thing, but we have to have 50 unilateral conversations, and those billable hours are running up like 7 hamsters on a wheel, running furiously. And of course, who's paying for all of this? The investors are, because it's all charged to the fund. Yes, there might be a cap on org costs, but those caps get ever higher, and quite a lot of legal fees can be carefully and discreetly carved out of the fee cap. So what ILPA has said, it just is an utter head scratcher, and actually is incredibly disheartening when you think ultimately of whose money this is, just this game that is being played from the legal side. Again, you come up with you write an egregiously pro-GP starting draft. You have 50 globally sophisticated investors who have their own legal counsel. Legal counsel ping-pong back exactly the same questions, agree to some but not all. Everybody makes a few $1 million in legal fees, and then we put it to bed and then rinse and repeat. We start exactly the same with the next one from the next GP, where we've reused the same template for the LPA and the PPM. These are not complex vehicles, or they don't need to be as complex as they are sometimes made. So a standard core agreement, like an ISDA agreement, that then has the equivalent of a credit appendix, which really takes account of the differences of that specific strategy and or contract, could save this industry hundreds of millions of dollars a year, essentially, of the repetitive and duplicative legal discussion. I mean, the notion of having exactly the same core LPA, reusing that for, if a law firm is representing 20 GPs over the course of the year, launching 20 funds, they're going to rinse and repeat 20 times for essentially the same document. And then just the duplicative conversations, 50 LPs raise exactly the same question. They're all having to negotiate individually as the billable hours rack up.
And let's hope we can make that your legacy. I think it's going to be very interesting to see how that evolves.
I have a feeling the lawyers will come after the accountants. So I'm now going to go into a bunker and avoid legal costs.
So we're already into record-setting territory for the length of this podcast, but I'd love this conversation. So I'm going to keep on keeping on, at least for this last topic about fintech. And it's invaded virtually every business. And I'm curious to see, in the craft of operational due diligence, I'm assuming it must be either looming large or integrated large, or maybe both. How has this impacted your business, and how have you embraced, maybe more recently, generative AI, but machine learning and just some of these fintech-based tools, and a lot of fintech-based platforms on due diligence today as well? So what is the current state of play, and how have you seen that evolution?
I think it's fundamentally changing. And part of this is as diligence moves from being more of an art to more of a science. Now, I do have a degree in history, so I like the art side. But an institutional process is something that is consistent, evidenced, and auditable. And that requires a structured workflow that is driven by technology. I think also we've moved away from diligence being about reports at a point in time to much more of an operational risk management process over a portfolio. So when we are looking at a large pension fund that might have 280 external asset managers and 600 or 700 lines, you can't do that in the good old manual way of get on a plane with your laptop, fly to San Francisco, interview an asset manager, and write a due diligence report. Where we see the changes coming is both the use of technology and the purpose of technology. We're all being asked to do more with less. And I think the tools to be able to adequately monitor the ongoing changes in operational risk profile of external asset managers, that requires fintech tools to be able to aggregate data, highlight risks, highlight managers or evolution that's out of expectations. That all needs software technology. It's becoming very much like vendor management or supply chain due diligence for more thoughtful and certainly more institutional, larger investors. Really, for a pension fund, an asset manager, it's a service provider. It's providing a service, needs to be monitored, and it is like tracking a supply chain. I think the one area that we focus on at Castle Hall is obviously different ways of doing this. We do think, and for my final comment to wrap up, that there is an awful lot of duplication in due diligence. At the end of the day, the first half of the process, probably, to be honest, the first 75% of the process, it's the same for everyone. Who is the manager? When were they formed? How many people have they got? Who's the auditor? What accounting system do they have? What's the compliance consultant? Is there any nepotism? These are all basic data points. And what we do at Castle Hall is aggregate all of that together and then use that data that we gather on behalf of all of our clients to generate an industry benchmarks. I think the notion of individual investors reaching out to all of their GPs and asking for basically the same thing in slightly different formats it's hugely duplicative and a real burden on the industry. And whether you do that using Excel or a questionnaire or an online due diligence tool, it's just empowering everybody to handle things individually and not get any economies of scale. ODD remains a bit like pricing credit default swaps before market partners came along. Everybody's doing it themselves. There is really an opportunity for some sort of standardization and consolidation.
Well, you have great views on that topic, and I'll leave it there. So, Chris, thank you. And as they said in the old days, keep the cards and letters coming. But I think for you, your post, your views, your thoughtfulness, not everybody has to agree with you or I, but discussion makes our industry a better place. And we've got to get there. And I appreciate the leading role that you take there. So thank you to you and your many colleagues at Castle Hall. We have a lot of Kaya members inside of your shop, and hopefully that helps yield better outcomes for the end investor. So thank you.
It does. And thank you again very much for the opportunity today. Really appreciated the conversation.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.